Hey everybody, Chuck Carnevale here, co-founder of FastGraphs, the fundamentals analyzer software tool, also known by many of you as Mr. Valuation. And speaking about valuation, we are in the midst of an extremely highly valued stock market right now. And I think everybody's aware of that and everybody knows that and everybody talks about it quite a bit. And valuation is critically important. But I also like to point out, as I often do, that it's a market of stocks and not a stock market. And in that context, we've actually had in many areas kind of a stealth bear market happening. In other words, there are some really good companies starting to come into fair value. What I've got for you today are three stocks that operate in the food industry. The old adage that people got to eat, I think is really appropriate here because, food is a staple and everybody eats 3 times a day and probably more for most of us. But the key is, food supplies are critically important to feeding the world, number one. And number two, food prices have been rising and are forecast to continue to rise. So what I did was I came across 3 companies that operate in the food industry that I think are attractive currently and could be good opportunities to look at. A couple of them have prospects for incredible growth, and there's also some dividend income here. So let's take a look at 3 companies in the agricultural and farm machinery industry and 2 companies in the fertilizer, agricultural, and chemical companies. In other words, companies that help farmers grow the food that we eat. So let's start by looking at AGCO here on the portfolio review. It's BBB- rated. Corteva, which is a spinoff from DuPont, is A- rated. And then FMC Corporation is BBB-. What's interesting about these companies is that they are growing rather fast, as I'll show you here in a moment. But recently they've come into a kind of a bear market territory. So let's kind of put that into perspective by first of all looking at the S&P 500. This is the fast graph. And the blue line here represents a PE of just approximately 17 and the orange line a PE of 15. And you can see that that's been a pretty good standard valuation for the market. And there are times when it gets a little higher than that. But very recently, despite COVID, which actually caused a drop in earnings for the S&P 500, we've had this enormous rise where the index's stock price has significantly disconnected itself from its intrinsic value, which would be the orange line on the graph, or even its more recent aggressive market value, which would be the blue line on the graph. So we have this very, very expensive market, and consequently, it's hard to find value. But there also, I'm starting to see more and more of, and I'll be, doing videos on this in the future. We're starting to see a lot of companies come into fair value. I've discovered a bunch of them here just recently, just doing some research yesterday. But I've got 3 that are kind of in the feeding the world sector that I want to show. And I do want to point out that they've kind of had their own bear market. So the first is FMC Corporation. And this is a very interesting company. If you look at it, this company is essentially involved with agricultural machinery and so on to help grow food for the world. So let's go ahead and look at it here a little bit in terms of what they do and, what kind of products they sell and that kind of thing. So I like to go into the company's websites and look for this kind of information. I'm here looking at their annual report. There's an issue with this company that I want to bring out right off the bat. If you look at it and look at its past earnings historically, I want you to note that the company stock price tracks earnings very closely. Earnings have been pretty steadily growing. They did suffer a little bit during the recession of '01. The company initiated their first dividend in 2006, as you can see by the white line, with a payout ratio of about 11%. And they maintained that low payout ratio up through about 2014. They raised the payout ratio to 15%, then up to 23%, and then back to 14% again, but recently they've risen it to 26%, and they, look like their dividend is going to continue to grow going forward. Now, they did have this little slump here where they made an acquisition in 2015, and that acquisition also caused them to have some issues with their operating cash flow, because this is a dividend payer, just under a 2% yield, but they went negative operating cash flow, but that was primarily to some costs in things like taxes. If you look at their 2015 statement of cash flows, you can see that their operating income was $634 million. They had $292 million in change in accounts payable and loss. And then they had $340 million tax payments net of refunds. And then they also had $264 million in associated costs with the Cheminova purchase. They made an acquisition of a company called Cheminova. So that was one little blemish, if you will, in their operating cash flow, but their cash flows recovered very quickly, and they've been growing their cash flows very nicely ever since. So what I'm really looking at here, not so much as a valuation, but dividend coverage, and the company's dividend appears to be very, very well covered by cash flows. Looking to the future for this company, now, before I do that, its historical growth, and I'm going to go back to operating earnings here. Cash flow has grown at around 11%, 10.7%. Operating earnings have grown at just under 7.6%, 7.59%. And the company is forecast to grow earnings for the next year for this fiscal year at around 9%, next year at 15%, and then 17%. Long-term growth is expected to kind of move back into the 8% era, but if I add current estimates to this gives the company some pretty good growth potential and an opportunity to make some pretty significant rates of return with some nice dividend increases. The company's long-term performance has actually been very strong relative to the index, notwithstanding that one little error in 2015 that I showed you. The $10,000 investment in this company back in December of 2000 would have thrown off over $11,000 in dividends, would have given you almost 12 times your money, turned $10,000 into $119,000 versus $36,000 in the market. Keep in mind, this was a very good time for the market as well, and yet that's a 13% return versus 7% for the S&P 500 with good forecast growth going forward. A 1.98% dividend yield, and that 5-year compounded average growth of their dividend has been about 25% a year. Part of that was from that increase in payout ratio that I showed you here earlier. So, the company is committed to paying more of their dividends, at least they have been for the last couple of years. Now, the next company I want to show you is Corteva. And this was a spinoff from DuPont, recently. And, it really has tracked its earnings very closely since the company was spun off, and this goes back to 2019. This actually is a long-established company, and again, another company that's in the fertilizer and agricultural and chemicals sector. And again, we can go quickly look into the company's website through FastGraphs here and see that their basic businesses are, helping farmers. They offer pesticides, crop protections, products like that. The company's growth has been stellar and expected, including estimates, at almost 22% a year. Forecast growth for this company just for the next couple of years expected to be over 20%, almost 21% a year. I'm using a very high, I'm using the P equals growth rate valuation reference here. So I'm using a PE of 20.99, or we'll call it 21 rounded here as the PE ratio, but that still gives us a 15 or 16% expected rate of return going forward with a current dividend of 1.27%. Performance since it's been public has been essentially in line with the market, but I do want to remind you this company has recently corrected rather significantly in 2022. And if I go back to the S&P, we're measuring the S&P being extremely overvalued. So in spite of that, this company has produced a performance record that's actually very consistent with what the S&P did, beating it slightly on capital appreciation and generating about twice as much dividend income over its short history as an independent public company. Forecast to grow extremely fast going forward. Long-term growth is expected to exceed over 23% a year. And the company, again, has recently come into a reasonable valuation range. So it's a nice little food stock that I think you might want to take a closer look at. Moving on, I want to go to AGCO. Now, this company, I was kind of misspeaking earlier when I was talking about FMC. This is the company that makes agricultural and farm machinery. The previous companies work in things like fertilizers and chemicals and, things to help farmers grow and protect their crops, as I pointed out. AGCO, on the other hand, they actually purchased Massey Ferguson tractors years ago. This company is known really as a equipment company. If you look at their brands, they're classic brands. There's Massey Ferguson. They also have significant brands in things like planters, where they, have helped farmers plant their crops. Just a lot of farm equipment that helps farmers, grow crops and grow enough crops for all of us, to basically work in. But they also have crop protection, grain and protein brands where they sell different seeds and everything that have been, promoted to help the farmers grow. The company offers a modest dividend yield. Now, they did pay a 4% one-time special dividend here. The graph is showing that dividend continuing. I don't think that's accurate. I think that's why the yield is only about 0.61%. But looking at this company going forward, analysts expect growth to be over 28% a year. And just for the next couple of years, this year over 70% growth, which is kind of anomalous, followed by 11 and 8. But then if I go into the custom calculator and combine those growth rates together, you can see there appears to be, assuming the analysts are correct, a very strong long-term opportunity here. Company's a little bit cyclical, but it does offer the potential for some very, very nice growth. Anyway, I kind of like the food stocks. I just think they're kind of interesting, or companies that are helping us grow food. I might point out, I think these are more, capital appreciation companies. The companies are pretty strong, pretty decent stocks. They have excellent track records, as I showed you. And these are stocks that I'm starting to take a closer look at. I don't own any of them. I'm only beginning to research them myself, but I thought it'd be fun to share it with you, our YouTube subscribers. So thanks for watching. If you liked the video, give me a like. Pound that like button, give me a thumbs up, and subscribe to the channel if you haven't already. As always, I appreciate you. And remember, there is no replacement for comprehensive research and due diligence. But here's 3 stocks that I think you might want to take a closer look at, especially if you're looking for capital appreciation with some, little bit of dividend thrown in. Thanks for watching.